This is Dennis Williams, the creator of CashMap, and thank you for joining me for part 5 of our 5-part series. In this particular session, we're going to be looking at how it's the simple and easy way to manage your line of credit, to keep your dollars working 24/7 continuously. So let's get started by looking at our scenario overview. We're looking at a $375,000 mortgage at 4.5%. That $6,900 is deposited monthly. That roughly $6,500 they have in monthly expenses, leaving them about a $500 positive cash flow, which are the bills left after their expenses are paid, and $10,000 in savings. With a 30-year loan, we're going to see that over the 30 years, if no additional payments are made, they'll be looking at paying $684,000. The interest will total $309,000, and the additional payments shorten the loan's life. And if nothing is done, half of the loan will be paid in 19.75 years. So over 12 months, we can spend just $130 in interest in this scenario to make $20,537 in principal payments. This $130 is paying an additional $13,000 in principal. It's enabling us to pay off the loan 21 months earlier, saving us $27,000 in interest payments, and building a savings balance of $14,000. Our alternative is to do nothing and see our savings grow to $21,000, earning a paltry $354 in interest at 2%, and continue to pay that loan month by month. So to get started, we've created a line of credit scenario here in which our billing period starts on the 1st and ends on the 30th. We're paying our loan on the 15th of the month. Our expenses have been moved to the 30th, giving us in orange an average daily balance on the line of credit of $190, which costs us 79 cents for borrowing that $2,500 that we withdrew on the 1st. And because we did end up paying off part of the line of credit during the month, we do have dollars sitting in our checking account, which will bring us an average daily balance of roughly $1,300 and get an interest payment of $2.11. So key insights we want to look at is that each month, the positive cash flow reduces the line of credit balance. As the monthly income and the positive cash flow increases, the line of credit withdrawals increase. And similarly, if your income and positive cash flow drops, the line of credit withdrawals will also decline. Additional withdrawals are tied to the balance of the line of credit at the end of the billing cycle. The more that we decide to apply to savings, less is being used to pay down the loan, and in turn this takes a little bit longer to pay off the loan, and so the user creates that unique balance that best suits them. Once the loan is paid off, 90% of the positive cash flow is then going to savings. So let's go back to CashMap Pro. In one of the first maps, we indicated there'd be a 2% increase in income every year, and 40% of that would be applied to positive cash flow. And the map shows you exactly what that amount is. And it gives you a graph showing what the average cash flow is month by month over the next 15 years, as well as listing it in a table. We then move to our savings selections, in which we're putting aside 20%, and we're distributing our dollars between a conservative, balanced, and aggressive saving profile. And again, it shows it to you in a graph. And we then move on now to the actual loan, where we provide the detail to the loan and of the line of credit, showing us what the payoff date is going to be on our interest savings, and the amount to start the solution, our threshold the first year for when we take an additional withdrawal, and what those amounts are going to be. And lastly, it shows you the estimated line of credit amount that you'll be needing to actually implement this solution. CashMap Pro then shows you the month that you will be tentatively taking these additional withdrawal amounts from your line of credit, and similarly what the line of credit balance will be. So over the first year, here's what the line of credit looks like as far as the balances, the withdrawal amounts. over the first roughly 12 months. If we look at this over the next 8 years, we can see what the positive cash flow is year over year, and we can also see how the line of credit balance gradually increases, and we can see that as the cash flow brings that line of credit down, we make additional withdrawals, and we can see that here in this particular graph, the amounts that are being pulled for the line of credit and what impact it has on the balance on the line. So we can see that achieving our first option is really doable. The mortgage can be paid off in 15 years. We actually can save $108,000 in interest payments, building $86,000 in savings over 15 years, and building a $1.1 million savings over a 29-year period. This is done safely, simply, with a $15,000 line of credit at 5% interest. Again, here's the balance of the graph if we do nothing versus paying it off in 15 years, and what the difference is in what our savings can be versus using the conventional approach in the blue line, and what the green line shows just how your savings will just take off by taking and keeping your dollars working continually for you. Thanks for joining me. To learn more, visit our website. We got over 90 articles, ebooks, interactive resources, and consulting options for you to review. And if you have other scenario ideas that you'd like me to review, send it to me at admin@cashmapapp.com. Thanks a lot, and best of luck in keeping your dollars working 24/7.